Welcome, everyone, and thank you for joining us on episode 20 of Bullish. Remember, anything that we discuss is not individual investment advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. You know me, Sam Hardy. We got Nick Stenger, producer Owen. We are Stenger Family Office for the past 43 years. It has been our mission to deliver clarity and confidence to help secure your financial future. If you haven't already, make sure you like, subscribe, share the clarity, the confidence, the good news with your friends. We've got another fantastic voice in the industry joining us today. Tim Urbanowicz, welcome to Bullish.
Great to be with you, Sam.
All right, so I'll do a quick bio for you here. Tim Urbanowicz is the head of research and investments at Innovator ETFs, which manages just over $20 billion in assets. You spent some time at JP Morgan, PowerShares, then Invesco. Prior to Innovator, you were a senior investment strategist at Northern Trust, graduated from Wheaton College, just down the road, CFA charter holder, and you publish a monthly newsletter, Dialed In, which I read every month. It's wonderful. You can subscribe on LinkedIn, folks. And then frequent contributor on Bloomberg, CNBC, Fox Business, to name a few. Arguably the debut of the century for you today. So thank you for joining us.
We know you've been on Bloomberg. We know you've been on CNBC, but it's really nothing compared to Bullish. So
nothing compared to it.
Yeah, no, it's exciting. So thanks for coming on the show. Quick question for you. Are we going into recession?
I don't think so. But I do think you need to be aware of it. Okay. And we're coming to this point in the cycle. The last couple years have been all about inflation. It's going to be all about the economy from here on out. So we need to keep focused on what does that outcome look like. I think there's a chance, but our view is that you're going to see the economy slowing, but it's not falling off a cliff. And the moves that you saw last week where it was just complete panic, just complete chaos out there, I think it's an overreaction. Okay. And that's an opportunity to add to high quality stocks, add to your portfolio, because again, it's slowing. I don't think we see any evidence that you're going to see a recession. Even if we did see a recession, let's say we did, this is not a 2008 type scenario, right? This is not a 2008 type scenario. It would be mild at best.
So a lot of people were talking about the Sam rule, saying that was going to be the next trigger, that was indicating we're going into recession. She came out herself, I think, and said, hey, this is not indicating a recession. So that makes us all feel a little bit better. But then you see the consumer reports, right? Like you see Home Depot come out this week and they're like, hey, consumers slowing down a little bit. They're pushing some projects off. Does that concern you at all when you see some of these consumer brands say we're having a little bit of a slowdown on our front?
Nick, I think it's a good thing, honestly, right? Because we need that to happen to get rid of the bigger issue longer term. And again, you see that inflation continuing to slow. The slowdown needs to happen to take care of that longer term. If you don't have a slowdown, everybody was hoping, we don't want to slow down. We just want inflation. That doesn't happen, right? You need people to feel it a little bit. They can stop spending as much money. They think about purchases before they just go out there and buy something they might not need. So when they slow down, you have a better balance between supply and demand. That's exactly what we need to happen. So when we look at these consumer stocks, which I don't know if we'll talk about a little bit, I think we need to be cautious on those in the near term because of this slowdown. But still, that's a good thing. And we need to stay focused on that. And again, I think you see these opportunities when people overreact. Just to put the overreaction in context for you, even right now, I think we're still seeing a big overreaction. You look at what the market's pricing in for the Fed. The expectation is that you're going to see 50 in September, 25 in November, 25 in December. That's the exact same path of cuts that we saw from the Fed leading up to the global financial crisis. That's what they did in 2007. So to sit here today and see the economy slowing, but the economy is still in a good spot, that expectation that we're going to see that, I just don't see it, right? And I think there's going to be a little bit of disappointment on the interest rate front. I think it's going to be a slower walk down than most people think. But if you see that overreaction in stocks like we saw last week, I think it's a good time to capitalize.
Do you think the Fed cuts too soon, puts us back into an Arthur Burns scenario, and then inflation comes roaring back? I think Powell's aware of that risk, but do you see that as a scenario?
If we were to go about a very aggressive pace of cuts potentially, I just don't see that the Fed going to do that, right? And I think it's going to be, most Fed cycles, what you see is you tend to take the stairs up and you take the elevator down. This cycle, we took the elevator up, and I think you're going to take the stairs down, and I think that's a very good thing. And I just don't think we're heading back to the zero interest rate policy environment that we had been in for the previous decade, right? Why would, if you still have an economy humming along, you still have an economy doing well, why would we do that? Why risk it?
Well, it's such a unique environment. We talk about this all the time where you see wealthy households so different right now. And it's sad to see really. I mean, it's the wealthiest 1%ers, 10%ers are actually doing really well right now. They don't have debt. A lot of our clients, baby boomers, literally don't have a mortgage, don't have car notes, don't have a ton of money going to debt payments, if any. They're making 5.5% risk-free on their cash right now, doing just fine. And then you have this whole other spectrum of the economy not doing well at all, barely making ends meet, can't rub can't rub two nickels together, can't put, what was the stat? It was like the average household can't come up with $1,500 in an emergency, right? So what does that do long term? Is that a serious issue? Does it ripple into the rest of the economy, or is it like, do the top households, are they doing well enough to just support the rest of the economy?
Well, I think they are doing enough to support the rest of the economy. That's a bigger problem, I think, long term that has gotten worse here since COVID. I think the government spending, that's a huge contributor to it. It kills the people that they're quote unquote trying to help. They're absolutely killing by pumping all this money in the stimulus that we saw through COVID. It's a long-term killer. Those people that, they got the stimulus checks. Okay. Now they're going out to the grocery store, they're paying $7, $8 for a bag of chips. I mean, it's ridiculous, right? Yeah, that was great. You got that one-time boost in your account, but look what it's done. And that's the issue. The more they spend, the more inflation is going to be an issue. So hopefully right now, this is why we think higher interest rates for longer will be a good thing to keep all levels of the economy humming. But even in the short term, I think there's going to be a big separation between those companies that cater to the higher end consumer versus ones that cater to the lower end consumer. It's just that like you said, people are making more money. They're earning more on their savings. Their equity portfolios are doing well. They have a mortgage locked in at 3% versus the lower end consumer. Their rent payments have gone through the roof. They're paying more on their debt. Their credit card's killing them. It's just widened that gap.
Yeah, and I saw a stat this morning. It said personal household savings was 6% during COVID, or 8% in the upper end, and now it's down to 4 or something, 3 on the lower end. Is that a problem? Do you see any concern where consumers just aren't saving money on the bottom end?
Well, I think they're gonna run into consumers are gonna run into some issues. But again, I think going back to the fact that this is actually a good thing, right? You look at all the spending over the last couple years. Everybody had a job. They're making money. They're out there spending money, but they're also stimulating that spending even further by all the excess savings that they had. They're spending their savings. It's easy to get loans, so they're able to spend from borrowing, and then they're spending through that savings. So they really had that trifecta, 3 buckets that they could spend from. You cut a couple of those buckets off. I think that's where we start to see the supply demand come into better balance, which is exactly what we need to see. So yeah, it's a negative short term. People are going to feel it. But longer term, I think it's a very beautiful thing.
So less on the side of doom and gloom, we're going into collapse, but more on the side of just normalization. We've been out of whack for a while. Now we're returning to the median.
Exactly. And I think when we talk about this is not a 2008 scenario, the consumer balance sheet is in much better shape. You don't have the excess leverage that you had back in 2008. I don't think asset prices or the housing prices are bubbly like they were back then. So a slowdown is not a bad thing. Even a recession, a shallow recession, right? It's not the end of the world. Sometimes it takes that short-term pain for the long-term gain, and I think that's what we need to focus on.
What's the next shoe to drop? If you watch the Fed and their last meeting, they're starting to get a little bit more in tune with labor markets, and I know they watch the JOLTS report pretty closely, but is that the next shoe to drop? Is it like, hey, we see a significant spike up in unemployment, and that triggers like, okay, now we're into the elevator of cutting rates?
I think so. Again, it's going to have to be a pretty decent spike. And if you look at just the starting point that we had for the longest time, I mean, job openings were through the roof. Now it's starting to come back down where it's in better balance, where you don't have all of these job openings per unemployed worker, right? So it's a better balance. And you look at unemployment where it is right now, we're still below historical averages, right? It's not a bad thing. And quite frankly, I think this economy has changed. You look at people who get laid off, the ability to even go drive Uber right now that wasn't available to them, 5, 10 years ago, right? That's a big deal. You get laid off from your job. Oh, you can go make 60, 70, $80,000 driving Uber until you find a new job. The economy has changed. Even just gigs that you can do online. I mean, it's so much flexibility. With all of that out there, I just struggle to see an environment where we just see this massive spike up in unemployment.
Do you think we see an increase in layoffs? I know, I think it was a couple months ago, you wrote just talking about, hey, companies were really able to bolster their margins in an inflationary environment. They were able to increase prices. We saw healthy margins there. Now you can't necessarily do those increases. Maybe we're going to see some cost cutting measures instead. We've already seen a decent amount of layoffs. Does that continue?
I do think it does. And especially and I think this is why we're so cautious on consumer stocks right now, because I think that segment is going to feel it first, because they're going to feel the demand side of things. So you look at when we have a period where inflation is going up, it happens every time throughout when we look at historical episodes. Companies are out there, they're able to increase prices, actually increase margins, because people are just paying those higher prices, right? Inflation continues to go up. They raise prices. Everything's going up, so we got to raise prices, and their margins actually increase. On the flip side now, when inflation is coming down, this deflationary process, right? It's the exact opposite, where now they can't raise prices. Consumers are becoming more price sensitive, right? So they can't just continue to pass through those higher costs to consumers. So they have to cut other places if they want to maintain those margins, which you're already seeing margins really across the S&P 500 come down. You look at a company like Home Depot, the last earnings report, their margins down 22 bips already. They're anticipating that to drop even further. And that's just the dynamic. But again, I think I go back to the fact that this is exactly what we need to see, right? It feels painful, but it's exactly what we need to see at this point in the game. But from an investment perspective, we also need to think about what that means, right? And it probably means, like we've seen every time this deflation process plays out, that earnings are probably going to take a hit. In the hard landing scenarios, S&P 500 earnings typically fall a little faster, fall about 18% on average. Even in soft landings, they fall, but it's more of a blip. Okay. And again, I think that's a good thing.
Do you think at this point we've achieved a soft landing and then we're kind of moving into the next cycle, or what are your thoughts there?
I think it's too early to tell.
Okay.
And what's so interesting, one of the charts that I love showing all of our clients, we have all of these newspaper clippings from all of previous Fed tightening cycles. I think it's the last 8 or 10 cycles that we see. And every single one of them, the expectation is always that the soft landing's coming. It's always, no matter what it is. 2007, you look at it, my favorite articles, it's Bernanke sparkles in first year as Fed chair, soft landing on the way. It always feels that way. And that just has to do with the delayed impacts of the tightening cycle, right? It takes a while. Fed hikes, you don't see that impact right away. It's delayed. And a lot of times people get fooled thinking, oh, everything's good, but it isn't, right? And I think there's a lot of signs this time that give us hope. But I think right now it's really about we got to prepare for the potential for that in the short term.
What about the Chinese consumer? Because we've been talking about this internally, where you see China saying, "Hey, we're doing fine. Like GDP is still growing, making up their made up numbers, right?" And then you see Porsche say, "Hey, we made double-digit growth in North America. We made single-digit growth in Europe, and China was down 15%." And then Rolex says the same thing. LVMH says the same thing. You're like, I'm not a mathematician here, but you're saying your GDP is up, and then all of consumer sales and consumer brands are already extremely weak in China. There's got to be a mismatch there.
I think they're a mess. I think it's an absolute mess. And you look at just this last quarter of earnings, China's a mention in like almost everybody's, hey, this segment is slowing, or we made up for the slowing China sales here or there. So I think they got to do a lot more stimulus than they've done to really reignite that economy. But it's an area I think you got to be cautious on right now. And even US companies that have high exposure.
Would you agree with Peter Zeihan, for example, the guy who says that China's on its last generation or close to the last generation? They got 10 years left and that's it.
I don't know if I go that far. I think the days of excessive growth like we saw the previous decade are probably behind us. Are they an emerging market? Technically, I don't They shouldn't be, right? They really shouldn't be. So I think those growth rates are slow, and I think they'll still grow, but I don't think it's going to be at the clip you saw over the last couple decades.
So that being said, does China have the potential to take out the rest of the world economy since they're such a big piece of the world, and GDP be number 2 after the US? Or is it just China has some issues, it's a blip on the radar, and everything else is okay?
I think it's a risk you need to be aware of, but I don't think it's like the US in 2008 where the US slows down, the whole world slows down. The US is driven by the consumer, right? Chinese consumer a lot less important than the US. So you get a lot of manufacturing over there. So I don't think it would be the same reaction that you saw in like a 2008 US slows down, the whole world goes rogue.
Yeah, and we talked to Strive Asset Management, who does the proxy voting, a couple episodes ago, and Matt Cole, their CEO, had talked about the same thing. He was saying China, like Starbucks in China, for example, not investment advice, not telling you what to do with Starbucks, but like a massive exposure. What was their plan? By 2025, they wanted to
I think it was like double their stores. Basically, 50% of their stores would be in China and 50 would be US. Obviously, they have Europe and stuff, but it's yeah, they were basically going to double their store count, and they were going to do it through China.
Right. And same thing with a lot of these consumer brands where they're like, hey, we maxed out what we can do in the US. We're getting close to maxed out in other markets. So let's go all in on China. It's like, that's a major risk.
It totally is. It totally is. And I even look at like, the EV piece of this right now. And I think this is going to be a huge, huge issue for the election, right? And I think this is why, if you look at like Musk all of a sudden just being so close to Trump, this is a big reason for it. I think the main reason is they wants to keep the Chinese EVs out of the US because they're manufacturing them and producing them at a cost nowhere near what we're able to do in the US. So a lot to think about for US companies. I think it's a huge issue that's going to be determined by the election.
So is that Musk pivot toward, he used to be a liberal and everybody on the right hated him. And then now he's like somehow kind of like, he says he's centrist, but he's, endorses Trump. Is that less of an endorsement of Trump and more of like, hey, please protect Tesla?
I think so. I mean, yeah, I mean, I'm sure there's other issues at play, but I think that's the biggest deal. You start letting Chinese EVs flood the market. I mean, you can get a high quality car for half the price.
And it has more features. I've seen a bunch of because I've got a million car things I follow. So to your point, yeah, it's like half the price of a Model X, and it's got twice as many features and is equally as nice.
Well, it may have all those features, but
it's also tracking everything that you do.
Yes, it is making a clone of you as you speak. And also, if you say something President Z doesn't like while you're in the car, done, car's off. That's it. That's the end of your driving.
They're going to keep them out.
I
really do.
Back to your 15-minute city.
Yeah, well, that's a whole nother topic for another day.
Going back to elections, by the way, who's going to win in November?
Well,
this is a layup question, obviously.
I have to think Trump. I really do, and I think for a couple of reasons. I even though there's been all this momentum around Kamala recently, I do still think that the average voter will associate her with Biden and the policies. And if Trump would just focus on some of the key issues and stop worrying about her race and how many people are at her rallies and whatnot, I think he would win a landslide. Pictures. Yeah. I mean, I think
I had 20,000 people actually last night at a rally with AI. I'm just saying. It was incredible. Had a great time.
But you look at this. I mean, you think the issues people are dealing with. I don't think the average, like we're talking about the front end, the majority of Americans have struggled severely over the last 4 years, just to afford the normal everyday goods and services, right? And that's associated with the Biden administration. People remember that, and I think that was one of the reasons why Trump was leading so heavily when Biden was there. Obviously, with other issues with his health and all that, but. I still think people associate that. Look at the border, same thing. He's got to focus on those issues. If he does, I think, he'd be in a good spot. Right now, I think the betting markets have it about 50-50, 40% odds that the Republicans win full control of the presidency and the Congress. A lot of game left.
Yeah. Well, and okay, so let's say Trump doesn't win, and let's say it's Kamala. Is it still kind of like divided governments enough to protect against a lot of the craziness that potentially could come from one side having everything?
I would hope so. I mean, I think she's a lot further left than than she's trying to lead on right now, based on, comments that she's made in the past. But I do think, divided government would probably be the best thing for the markets overall, right? I mean, either side, I'm going to say Republican or Democrat, they get full control. I think the spending, the deficit issues are only getting worse. And that's what we need to be cautious of. So I think best case scenario for investors and for the American people as a whole is a divided government.
In the unlikely scenario, you get a Kamala presidency, you get Democrats to win the House back and keep the Senate. So Democrats in all branches. What happens to the stock market? Is there a scenario where you say, hey, like market's down 20% if that happens?
I don't think it's down necessarily. I mean, they would probably pass some changes to the tax code, which would be a negative. But I mean, you got to think, Nick, of the spending that'll take place there. I mean, I think that puts the market on another sugar high. And we just basically repeat what we did over the last 4 years, where it's good for the markets. People are spending money, and then we have that inflation issue reignite. So that would be my big fear, is that we have a reacceleration in inflation if she does get in and they have full control of Congress.
Yeah, it's almost a continuation of Bush, who was big government, big spending, Rhino Republican, and did a lot of the same policy Obama did. They were on different sides of the political aisle, but both of those guys looked the same politically. And then Obama was a continuation of big government, big spending, bad policy, but he didn't really do much with tax rates, didn't do a whole lot with other than regulation, which was killer. And the economy still did fine. We still grew. They kept rates artificially low. And it sounds like Kamala would be a continuation of a lot of the Obama era policies, where you grow, but it's maybe slower growth.
It is, because the bigger government gets, the more they get involved, the less money that you have going to the private sector, right? And that's just the truth of it. So you don't want to see that. But I do think the odds of, I was looking at it this morning, I think the odds of the Democrats taking everything are significantly low. I think it was the House or the Senate. They only had like a 15% chance to hold the majority there. So in my opinion, for investors, I think the divided government, probably the best case scenario. Because even Trump, I mean, I think he's got a lot of great policies, but he likes spending money too.
Oh yeah. No, we do talk about that all the time. He was it the CARES Act? And then Biden followed it up, and both of them participated in blowing up just the amount of money in the economy. So
it was just shocking, though. The Inflation Reduction Act, it didn't work. It's crazy.
No. It should be criminal to call it that too. It's just it's such insane. A joke.
Yeah. The Inflation Reduction Act added 20% more inflation to the economy. It's like 1984.
Yeah. So if we saw something like that, we might get a little bit bubbly, kind of like we saw coming out of the pandemic in 21. Do you think that all this talk around AI, and obviously valuations have stayed pretty much the same because a lot of these companies have had sales to back it up, but do you think we're in a bubble per se as far as the tech piece of it goes and the AI conversation?
I don't think so. I mean, it's such a night and day difference from what we saw back in 2000. So the simple fact that these companies have a lot of cash flow. You look at the amount of cash NVIDIA is printing. Are they cheap? Absolutely not. But can they grow into the valuation? Probably, right? So I think it's a night and day conversation. We're not in bubble territory at all. Are we cheap? No. But there are pockets too of that trade that I think are very, very favorable right now. We talked about like the consumer slowing. Probably want to be cautious on those stocks near term. But you look at some of these AI infrastructure names, this is not an area where I think companies are going to be slowing spending, right? So I don't think it's an area where you're going to see a huge hit to demand, even if we head into a recession. There's so much of an advantage for these companies to scale up, integrate AI, cost savings, efficiencies, increasing margins. So that's a big thing. So I don't think you're going to see a lot of these infrastructure companies slow down. And you look at the hyperscalers, basically the Mag 7, those are the ones that are spending on AI. They have huge cash piles, right? Mm-hmm. So we look at that. We don't think it's going to be slowing down. I know one of the holdings in our Frontier Tech ETF that's heavily focused on AI, Vertiv Holdings. They do a lot of the cooling centers for data centers. I mean, this is one that's not going away. People are scaling. They're adding. They're going to need that technology. The cloud storage. Those are companies that as this expands, they're going to benefit.
Yeah, there's almost been like 2 iterations of the AI craze where it was like, as long as you named your company .ai, you got a $50 billion valuation. And then that's like already coming down like dramatically, which is really good. To your point, it's normalizing. But then now it's like these actual companies that have real earnings, like Nvidia making billions and billions of dollars. That's not a Fugazi like 1999.
No, it's absolutely not. And I think there is a bifurcation of the companies that are just throwing AI in their name and they're running up. Those days are over, right? But there's substances, the Nvidias, the AMDs, the Vertiv Holdings, like those are the companies that are going to benefit. And yeah, a lot of it is already played out in Nvidia, but I think that next wave is those infrastructure plays that haven't necessarily seen the same pop as some of the chip companies like Nvidia.
I don't think you can also understate like how far behind a lot of zombie Fortune 500s are in implementing tech and like how early stage we are. Dan Ives talks about that all the time, and he'll say like, and he does like his little hand motion thing he does, and he's like, we're in the early stages of the AI, and I think he's right though, because up until COVID, I would on my drive to Oak Brook is where our office was at the time, I would pass maybe 8 or 9 different bank branches. And all those bank branches, every single one of them, I counted the other day, are closed now because banks were like, hey, wait a second. We can put this all on an app and save. And I heard it's like $2.5 million a year to run one bank branch. So it's like, okay, we can have an app and save millions of dollars per year. And they just figured that out 4 years ago, So it's like how much more of this is coming where we can go to just basic stuff. It doesn't have to be anything dramatic. It can be artificial intelligence, machine learning. And then you've got as long as I think with the AI play, if you're in the companies that are seen as the pipes and wires, you're probably okay. You just got to be careful. I don't know if you've looked at any of these companies where it just doesn't make sense what they do. And they're getting 300-400 times earnings on a multiple.
Yeah, that's what needs to end. But when we look at the AI chart, I think there's 3 waves of it, right? The first wave was Nvidia, the chip stocks that has, maybe has a little more to go, but the easy money's been made there. Right now, I think we're in the early stages of like the AI infrastructure plays, where those are going to be the ones that are going to benefit over the next year, 2 years. And then the final phase is going to be the ones that are actually benefiting from implementing the technology, which that could be those consumer stocks soon. Even like, Starbucks, Home Depot, saving cost on workers, increasing margins. So I think it's those 3 phases. I think we're in phase 2. And it's I think a lot of opportunity out there.
Yeah, absolutely. Do you have another chart you want to go through real quick?
Not necessarily. I did want to have the conversation though. We're talking about opportunity there. You wrote the great rotation or the great head fake, and that's something I'd kind of like to get into. As far as opportunities, where do you see it? Was it a head fake? Kind of seems like it was. Because large caps have just, and we talk about this often, large caps have been so dominant. The obvious play on the value side is do small caps, do international. China is so undervalued, it's ridiculous. Why would you not invest in it? So maybe just, build into, let's talk about what happened a few weeks ago where we saw this massive rotation, huge pop in small caps, mid caps, large caps, some of those, Mag 7 names pulled back a little bit.
Yeah, it's funny as I was writing that piece, because our view is that you want to stick with what's been working. I think now is not the time for small caps. I'll get into that in a little bit, but it felt at that time like small caps were going to the moon. Right? I remember putting that piece out. I'm like, man, I don't think people are going to like this. But then sure enough, Monday comes and, you see the giant sell-off in small caps and really haven't seen it since. But I think the reason for that is everybody associates small caps doing poorly when interest rates go up. So they assume when interest rates come down, they'll do well. And they're right on the front end of that. Higher interest rates are a huge drag on small cap names. They don't have the cash flows up front that the large caps have. So they have to discount those cash flows further back or further into the future. That hurts their valuation. But we really think right now is a time you got to be cautious on those small cap names. And again, going back to where we're at in this cycle, yes, we're at a point where interest rates are coming down, but we're also at a point where the economy is slowing. And I think that is going to be the key driver. Small caps do not do well when the economy slows or if we head into a recession, which you have to.
Yeah, they're the worst sector going into a recession, right?
It is. And what's funny, even if you look at returns historically, when the Fed cuts rates, it's not a time to be invested in small caps. Large caps tend to do better, right? Yeah, rates are coming down, but it's all about that economy slowing. And for us too, right now, you got to look at the earnings trajectory too. And I think you got the chart up right now here, Sam.
Yeah, it's a good chart.
Just looking at the first half of the year, the
I think you just have to click on number 5 there.
Yeah.
The attribution of returns in the first half of the year. Large caps, the good chunk of their returns were driven by earnings. Earnings increased, right? Valuations increased as well. But if you look at that relative to small caps, and we're using the S&P 600 there as a proxy, the entire return was attributed to valuations simply getting bigger. And what I thought was so interesting too, even when we started to see the rotation, expectations for earnings next year or the year after, they didn't increase. They weren't increasing. So you had this disconnect where earnings were down here, prices were up here, and those two need to come together.
Well,
right?
A big problem with small caps too is financing costs, right? And it's not, so even if the Fed cuts, and everybody's hung up on the Fed cutting, but we're cutting from 5.5%, right? Like are we going to 3 in the next 6 weeks? No, probably not. So, can you take all this debt on a small cap balance sheet and get it back to COVID levels? Probably not. I mean, my wife bought me a Traeger for Father's Day, right? And I'm like, this is great. A great product. I love using it. Smoked a couple, some ribs. I did a pork butt. It was great.
Did some steaks. Phenomenal.
Steaks turned out really, really good. So Traeger making a great product. So nothing bad there. But then I was curious about their company, right? The stock. So I looked it up. They have like $440 million of debt to make grills. It's like, guys, you're making smokers and grills. Why do you have any debt at all? Like, this is crazy. And they're profitable if you take out the interest expense. So it's like, if you guys didn't have debt, your stock would probably go up like 50, 60, 70% overnight, And I think a lot of small caps are in the same boat.
Yeah, I think that's another great point. I think you got to just be cautious there. Wake up. You got to know where we're at in the cycle. And then also look for opportunities. If you start to see, over the next year or so, as the economy slows, which we think it will, there's going to be opportunities where those valuations will come down even further, right? And then what we see that as is, all right, those valuations come down, the spring is starting to load. So when we do see those earnings expectations flip, when rates are a little bit lower, and the economy starts to reaccelerate, then you can see those big gains. But, the next year, 2 years, it's an environment where I think you're going to continue to see the economy slow and not necessarily great for small caps.
And isn't it then on the back end coming out of the recession, that's when small cap value can rip and some of these names can actually do pretty well?
That's exactly right. So I think you wait, there'll probably be a better entry point soon, but now just not the time.
Real quick, can we talk energy? I don't know how much you followed the energy trade, and obviously done really well this year. I think a lot of people expected, hey, Democrats are bad for energy, but it's been the exact opposite, because then supply gets choked and then oil prices go up. Our friends at ExxonMobil are printing money right now, doing very well. And so like, where do you see that going? Is energy kind of overvalued? You're trading a lot of these stocks at 15 times earnings. Can that go up? Are earnings capped out? Where do you see energy going?
I think energy is probably one of the best value and defensive plays right now at the exact same time. You look at all of the turmoil going on, whether it be Russia, Ukraine, the Middle East, which it's hard to imagine tensions cooling off there anytime soon. It's a tremendous hedge, against oil prices going higher, right? And it's a tremendous hedge if we start to see this inflation piece not falling into place. And it's extremely, extremely cheap. It's unloved. So I think it creates a good opportunity. And I do think even it's another election trade too. You see Trump get back into office, policies much more favorable to these traditional energy names than the Biden-Harris administration.
But let's say Trump gets back in. First of all, under President Trump, we had peace in the Middle East. We had less wars. We had more oil supply. Does that hurt the price of oil though? And then do you see possibly some deterioration in energy earnings because of that?
Well, I think you could. My view is always it's been so beat up. It's so beat up. So much bad news is already priced in, right? And it has been for years. That spring is loaded. So yes, it could. And they didn't, quite frankly, I don't think they did well the first 4 years with Trump in office. You had very low gas prices, but I think there's the risks are skewed to the upside as opposed to the downside.
By the way, Elon said he likes EVs, but he did say we can keep eating steak. So I'm really happy about that.
Your Traeger's going to be in good shape.
Yeah, exactly. Yeah, it's hard to smoke tofu on your Traeger.
I'm sure it tastes delicious though.
If steaks are banned, I think Traeger's going to zero. I think that's safe to say.
Yeah, I think that would be safe. That's going to be like a Peloton 2.0.
Yeah.
Or Peloton, whatever. You can give me a hard time for my pronunciations later.
That's a Bond Roth pronunciation right there.
Yeah, exactly. If you don't know us, we're joking. We love Bond Roth. Was there anything else? I think what we could do real quick is we always do that. We forgot it last time, but meme of the week. And I know we've already kind of talked about the bubble piece of it. This is obviously not a real quote. But if it's good enough to screenshot, it's good enough to sell. That was Warren Buffett back in 1969 before we had computers or anything like that, obviously, or
Which, by the
screenshotting
way,
existed.
We have the Berkshire Hathaway annual
from
report.
65 over there.
It's not an original copy, but
what's the biggest risk that you see in the market right now? Obviously we've kind of been through the meme craze. Maybe we see something like that because everybody wants to hit a home run. They want to, make this life-changing trade. And there's a lot of risk that comes with that. It doesn't always work out. So I guess the overall question is, what's the biggest risk to markets right now that you see? What should we be cautious of?
I think things move so quickly right now. You saw it this last week, sentiment shifts on a dime. People start selling. You have shorts that start covering and the opposite. So things move so quick, right? And I think right now the expectations of investors are very high. The expectations for the economy, expectations for the Fed. Right now, where we're at right now, I think the soft landing, maybe even more than a soft landing, is priced in. Don't forget that it always is priced in as we get to this point where the Fed is about to start cutting. So stay aware with the fact that consensus might not play out, right? Again, not necessarily a bad thing longer term. I think we need it to happen. You need to continue to see this slowdown, but don't just assume, like so many investors are right now, that because the data is still decent, that it won't deteriorate over the next several months. So I have a thing I say, always stay risk aware, but not risk off. You got to be in equities. Most important thing for any long-term investor. Through it all, you got to be in, but right now being cautious.
Tim, the show is called Bullish. If you could look into the crystal ball here. We did get it from Amazon.com, so it can be a bit fuzzy here and there. Where's the S&P going to be 18 months from today?
I think we're within 10% of where we are right now, probably to the upside. Just with where valuations are starting, I think the upside is capped. You even look at, I don't know where the market's at right now, but even after the report today where you continue to see inflation slow, you didn't see this huge pop. And that's because a lot of that good news is already priced in. And again, we're at this point, we think earnings are going to pull back a little bit. You can still see the economy grow, but it's going to be slowing. And so I just think those big upside returns of 20, 30%, probably not coming over the next year.
But still bullish.
Of course.
So it's like 6,000 points. We're at 5,400.
Sounds like we're going to Dow 500,000.
Yeah, that sounds amazing. So, well, Tim, we really appreciate you hopping on. Folks, again, if you like the show, like it, subscribe it, share it with your friends, give us a call, 630-912-8431, and we appreciate you listening in.
Check out Tim too. You have a Twitter?
No Twitter.
No, but LinkedIn. Dialed In is the monthly newsletter where you can subscribe there. It's a great read, and you usually have a nice story at the beginning.
I do.
A nice little comparison, and yeah.
Check it out. Thanks a lot, Tim.